2 days ago on Monday, I talked about the Bank of Canada's upcoming interest rate decision. It is now official. The bank has cut its policy rate by 50 basis points, and that now takes it down to 3.75%. Now, in that earlier update, I talked about the possibility of a larger than usual cut. Here we are with the biggest bank rate cut now since they started lowering rates earlier this year. So now, in this video, I want to sort of connect the dots between what we discussed on Monday and the bank's decision today. What has changed? What's the same? Most importantly here, how is this going to affect the economy going forward? First, why did the bank make this decision? Well, as I mentioned, inflation has cooled a lot. It was down from 2% in August to 1.6% in September. That's well now below the bank's target. Just over 2 years ago, it was sitting at 8.1%. We can't forget that. So it's come down a lot since then. Now, when you take this decline and you pair that with a sluggish growth that we're seeing, you compare it with high unemployment, it was the perfect recipe out there for a rate cut. It turns out to be 50 basis points. The bank, in its statement, they recognize that inflationary pressures are no longer a major concern. They've shifted their focus now towards supporting economic growth. But here's the big question. Will this rate be enough to kickstart the economy, or are we still in for some slow growth? I want to dig into the numbers here. In Canada, the economy grew by about 2% in the first half of the year, and growth is expected to slow slightly to 1.75% in the second half. Now, here's a very interesting fact. Consumption in Canada is still increasing, but it's actually decreasing on a per person basis. The unemployment rate, that is at 6.5% right now. The labor force is growing due to population growth. Hiring has been somewhat sluggish, though, especially for the categories of younger people and also for immigrants. Now, wage growth, that has stayed high, but not quite enough to keep up with productivity, which could pose a challenge. Now, on the upside, exports, this is a good thing here. Exports should be fine, and this is mainly because the U.S. is still strong demand down there. Canada's export sector should stay solid, at least for the foreseeable future. So when we look ahead here, the Bank of Canada is now forecasting GDP growth of 1.2% in 2024, 2.1% in 2025, and 2.3% in 2026. So with these lower interest rates, what should we expect there? Well, obviously the rates should help stimulate consumer spending, business investment, residential construction, but it is going to take a lot of time for these changes to be felt, across the entire economy. One key area to watch for here is housing. Demand for housing now is expected to stay relatively strong. That could lead to more residential investment and renovations. The bank in their statement say that business investment is also projected to pick up as economic demand increases. So while the pace of growth isn't dramatic, at least it's steady on an upward trajectory. Now, I do need to talk about inflation. Are we out of the woods there yet? Inflation has dropped significantly, like I mentioned, from 2.7 in June to 1.6% in September. So that's a pretty steady drop there, pretty significant. And this is largely due to falling global oil prices, which have brought down gasoline costs, which of course have a big impact on the inflation rate. When we look at shelter costs, they are still high, no doubt about that, but the rate of increase, the rate of inflation is starting to ease there. Overall, inflationary pressures are much more contained than they were earlier in the year. When we look at core inflation, so this strips out the more volatile items, think food, think energy, it's now below 2.5%. So it is clear that inflation is no longer the massive concern, at least that it was a few months ago. So what does this all mean for regular Canadians like us? Well, with that inflation rate now close to 2%, again, it's slightly below that now at 1.6%, the Bank of Canada's rate cut is aimed at supporting growth. That means that borrowing could become cheaper. That might be good news if you're in the market for a mortgage or a loan. That said, don't get too excited just yet. This is only the first step. In its announcement today, the bank hinted that more rates could be coming, but they will be taking a cautious, data-driven approach. We are going to definitely have to wait and see how the economy evolves over the next few months. If growth continues to struggle, we could see another rate cut at its next meeting, which is in December. The bank will be watching the data very closely, of course, to decide if and when to cut rates further. Now, for businesses, lower interest rates could make it easier to finance investments. So whether that's new equipment, whether that is expansion, whether it's renovations, that should leak through and eventually help boost the productivity and growth. Although, again, the effects of that will probably be very gradual. Some final thoughts here. The Bank of Canada is lowering rates to stimulate growth. Inflation seems to be under control for now, but there are still a lot of moving parts here. There are global growth trends to the labor market that could affect the outcome. The big question of the hour is, will this cut be enough to speed up growth, or will the bank need to take more aggressive actions in the months to come? What do you think? Will we see more rate cuts, or is this just a temporary adjustment? Let me know what your thoughts are in the comments below. Picture this, you are looking for an investment that can grow with you, something versatile enough to provide you with cash flow and growth potential. Maybe you're saving for a big purchase like a new home, or perhaps you're just looking to build a nest egg for your retirement. Well, the BMO Balanced ETF might be just what you need. It is a diversified portfolio that combines global equity with fixed income ETFs, and that gives you a broad market exposure with the potential stability of fixed income. Now, every quarter, the ETF adjusts its asset allocation to ensure you're always in an optimal position no matter what the market throws at us. Whether you are new to investing, whether you're a seasoned pro, the fund does offer a balanced approach that can help you stay on course towards your financial goals. You can find out more about the BMO Balanced ETF, how it can be part of your journey. Visit bmoetfs.com today to learn more. Two major restaurant chains are facing big challenges this week. Starbucks reported another drop in sales. It's working to turn things around under new leadership. McDonald's, they're dealing with an E. coli outbreak that is linked to its quarter pounder burgers. Let's look at Starbucks first. CEO Brian Niccol, he announced that the company's fourth quarter sales fell 3%. That is now the third straight quarter of decline. He admitted in a statement that the company needs to change their strategy. Here's what he said. Our fourth quarter performance makes it clear that we need to fundamentally change our strategy so we can get back to growth. And that's exactly what we are doing with our Back to Starbucks plan. The U.S. market, which is Starbucks' largest market, they saw same-store sales drop 6%. They saw traffic fall 10%. Now, a sliver of good news. Even though they had a tough quarter, the company did increase its dividend to 61 cents a share. Now, meanwhile, McDonald's, their shares are down pretty sharply after the CDC linked an E. coli outbreak to its quarter pounders. And this has led to 49 reported cases as the time that I'm reporting this, 10 hospitalizations, and 1 death in Colorado. The McDonald's says the issue likely stems from the slivered onions that's used in its quarter pounders that are sourced from a single supplier. They have pulled that item from certain states and temporarily stopped distributing those onions. So if you are a McDonald's enthusiast, there is a little bit of hope here. The company's USA president, Joe Erlinger, he said in a video, "We are working quickly to return our full menu in these states as soon as possible." He also said, "I hope these steps demonstrate McDonald's commitment to food safety." The CDC, it does warn that the outbreak might be larger than reported, as of course many cases may be going untested. So McDonald's, they say they're working with suppliers now to replenish their ingredients while assuring their other menu items, such as Big Mac, regular cheeseburgers, remain unaffected. There's an interesting trend developing here in Canada. We're seeing investors pull out of what are called thematic exchange traded funds, as the broad stock market indices like the S&P 500 are continuing to hit record highs. So themes such as artificial intelligence, solar energy, video gaming, they have struggled to maintain the investor interest with this ongoing bull market in the broader indices. So these thematic ETFs, they target specific trends. They're on track for their third consecutive year of outflows. They've lost $5.8 billion so far this year. This is according to Morningstar. Meanwhile, the broad stock market indices are setting a pretty high bar. The S&P 500 is up around 22% this year, driven, of course, by the big tech giants like Nvidia, like Meta, like Apple. Now, as a result, investors are flocking to the large benchmark ETFs. In fact, the Spider S&P 500 ETF Trust, it just became the first ETF to pass the $600 billion in assets. So that there's a lot of money flowing in there. Brian Armour, he's an ETF analyst at Morningstar, and he noted that investors often mistime their entry into these theme funds that could cause them to miss out on significant returns. He says you have to pick the right theme and then be sure that the fund has picked the stocks that will benefit most from that theme, and then be right about the timing of when you buy the fund. That trifecta right is tough. Another issue here is that thematic funds also charge higher fees, which can limit their appeal. The fees average a 0.62% compared with 0.09 for a broadly based S&P 500 ETF. So when will this trend shift? Well, probably we'll see a change here when the major indices, when the S&P 500 and the mega caps stop delivering. The focus will probably shift back over to thematic funds. That is a wrap for today's program. As always, I say thank you so much for watching. Appreciate that. I'm here Mondays and Wednesdays typically with this report. Thanks for watching this video. We'll see you next time around.